Good morning, everyone. Thanks again for your interest in coming to hear us speak today. I represent the Prudential Equity team, and unlike previous presentations that I've given, where I tend to focus more on our philosophy and approach to how we construct market-beating equity portfolios, today I'm going to touch on what is a slightly more tricky topic, but very topical at the moment, and that is that of shareholder activism. I'd like to leave you today after talking through 4 case studies. Hopefully, I can convince you that Prudential is an actively active manager of your hard-earned savings. So to start, I'm just going to use what I think is a very pertinent quote from Mark Mobius. In this quote, he touches on a couple of issues I just want to highlight. The first being that shareholder activism is not a privilege, it's actually your right as an owner of a business. As you know, you have a say in how that business should be managed, and if you're not happy with what you see in terms of the governance or resolutions that need to be approved, you are entitled to voice your opinion and have a say. The other point that he does allude to in this is that often shareholder activism comes about when things are going wrong. So it's often a case as an active manager can choose to own a stock or leave it out the portfolio, and sometimes, and what makes this topic a little bit tricky, is it's actually an acknowledgement that when the investment case isn't working, the onus is on us as the shareholder to try to unlock that value and ensure that we get things back on track. Over the course of the next half hour, I'm going to use 4 case studies. They're very different, but hopefully I'll be able to demonstrate where Prudential has been quite vocal and taken the necessary action to ensure that we end up in a better position than where we found ourselves during the course of the ownership of a given share. To just start off, I thought I'd just show this traditional view of an active manager. On the left is often we get asked, what do you own? What are your best stocks, or what is your top 10? But at Prudential, we tend to we prefer to think of the positioning in the portfolio as the chart on the right-hand side. So it's not only the stocks that you hold, but it's also the stocks that you've actively taken a decision to leave out the portfolio for us that are equally important. So as an active manager, you have an ability, as I say, to own something or to not own it. Invariably, the stocks that we are underweight, it's generally a concern about valuation, but it can also be concerns about the business model, the sustainability of that business, or the governance. And it's quite pertinent to one of the stocks we'll talk today about is Steinhoff, which was for us a significant underweight over many years. So just to elaborate on that overweight, underweight, this is the rolling 12-month returns, the outperformance, so the alpha that has been generated by the Prudential Equity Unit Trust. And we're very proud of this track record. As you can see, in the most recent 12-month rolling period, almost 4% outperformance relative to the General Equity Unit Trust peer group. But what's more important is the stocks to which we were overweight, shaded in green. You can see that typically we are very we have had success in picking stocks, but the point today is that it's actually the fact that we've also made money by not owning certain stocks in the portfolio. In the most recent 12 months, the most significant contributor to that red shaded area was Steinhoff. Our clients essentially were underweight the Steinhoff as a stock, and of the 4%, 2.5% alone came from our underweight position in that one stock. So that leads me into the first case study. All of my 4 case studies today, I've given a title. That title refers to either a movie or a book. In this case, Wizard of Lies. You may or may not know, but it was a recent Hollywood movie made about the rise and fall of Bernie Madoff. Bernie Madoff, as we know, is sitting in jail, 150-year sentence for running what is today known as sort of the largest Ponzi scheme to date. Why do we use this title? Prudential has, on occasion in the past, referred to Steinhoff as a Ponzi scheme. We could never reconcile the cash generation of the business relative to what they reported as accounting earnings, and I'll show you some analysis of what we think may have gone on at Steinhoff. We were often ridiculed for our sort of very strong view on the stock, but as we'll see and as we know, the events of the more recent sort of 6 months, it's our clients or you that has benefited from this continued avoidance of this particular stock. So in my case studies, I'm going to use the share price to tell a story. I think it will act as a certain timeline, but going back to sort of 10 years, we had long disliked Steinhoff. As I say, we could never reconcile how it generated cash flows, and the biggest red flag for us was that it traded on a low multiple relative to that of the average stock on the JSE, but it never had a dividend yield to match. So you weren't being compensated with a higher dividend yield despite its low PE. We, throughout this period, held a max underweight in the portfolio, and that led up to, so for that first part of this chart, it didn't really cost us anything. The share price, as you can see, sort of was range bound at around 20 Rand, but then it went through a sort of a period of rapid growth, making a number of acquisitions that culminated in the acquisition of Pepkor from Brait and Christo Visa. That saw the share price go from 20 Rand to almost approaching 80 Rand, and its weight in the index went from about a 1% position in the shareholder weighted index to around 4%. This meant, coupled with this transaction, Pepkor for us was a quality business. What always amazed us about Steinhoff was its ability to fund its growth through acquisition and the willingness of the vendors of the businesses it acquired to often accept Steinhoff shares as a form of paper or currency. As you now know, Christo Visa is certainly regretting that decision to accept shares as opposed to cash. But that rise in the index weight meant that in terms of Prudential's process, we do impose risk limits on the active positions in the portfolio. And so I wish I could stand here today and say we never owned a single Steinhoff share, but the reality is on the back of the Pepkor transaction and the improved cash generation that came from that business, we owned about a 1% position in the Prudential Equity Unit Trust. That was still a max underweight, and it still showed up as a top 5 underweight. Over the next period, Steinhoff successfully managed to relocate its primary listing from the JSE to Frankfurt, which may in fact prove to have been its undoing. Not only did that listing bring about greater regulatory scrutiny from different regulatory bodies other than the South African FSB, but it also went on a massive acquisition spree, acquiring businesses in Australia, the US, that also have prompted some scrutiny. July 17, there was a newspaper or magazine article in Germany alluding to some tax irregularities, and that's what prompted that sort of pullback in the share. And then, as you all know, in early December, we woke to the news that Marcus Jooste, the CEO, had resigned, and that the accounts could no longer be relied upon as a fair reflection of the financial position of the company. As I say, we held just under 1% across our client portfolios on the day of that announcement, and we took an immediate decision to sell all of our shares on that same day, exiting at about 19 Rand a share. Today, the shares languish below 1.50 Rand. 19 Rand is certainly a far cry from the 60 Rand at which those shares were possibly bought, but as I say, it still was a material underweight that contributed positively to the returns of the equity fund relative to the peer group. I want to emphasize that this is a scenario. It isn't necessarily what may prove to have been the case, but as a non-accountant myself, I felt it was useful to perhaps give some indication of why we could never reconcile the cash flows. So I'm going to talk through a series of accounting transactions. A Steinhoff manufacturer of furniture sells furniture to a furniture retailer. In so doing, it recognizes revenue or it generates a sale, and there's a receivable on the other side. In other words, the furniture retailer owes Steinhoff for the goods it has received, but most importantly, no cash has exchanged hands at this point. Next step, furniture retailer finds itself in an economy that's not doing particularly well, and is struggling. It tries to discount to try and move the stock, but that it has to come back to Steinhoff and say, please, can we renegotiate the terms of the receivable that we owe you? And Steinhoff, we could see from the accounts, would often take what was an accounts receivable in the working capital and convert it into a long-term investment and loan. What this also did, it inflates the operating cash flow and the cash flow statement. It makes you appear that they received the cash, but it's offset by a loan that it now has with that same customer. And more importantly, it actually it had the ability to then start recognizing notional interest, which inflated profits in the income statement. Still no cash has been received. Final step, retailer is now on its knees. It can actually it can't even service the interest on the loan, and it's unable to repay the loan to Steinhoff. Steinhoff comes to the market, and under the guise of we are going to vertically integrate as part of our global strategy, and we now not only going to be a manufacturer of the furniture, but we're going to own the end retail channel. It buys, for example, JD Group, and so in so doing, it's in the signing a purchase price for that asset, that bad debt disappears and just gets lost in accounting treatment of goodwill, or an allocation towards customer relationships, etc. So still at the very end of this series of transactions, no cash was ever received from the original piece of furniture that was sold to the retailer. How did this show up in the accounts? This is, on the face of it, why everyone liked Steinhoff in terms of what they showed you in the accounts. Operating cash flow was a steady growing. It didn't look like a bad company. But as I say, from that previous example, if you then make the adjustment between the operating cash flows and the financing cash flows, and you simply net off the one line item, which is investment and loans, that's what we think is a fairer reflection of the cash generating ability of Steinhoff. And the most important years to just highlight is 2009 to 2011, a significant marked reduction in what they would have you believe was the cash generation and what was available. This was the cash. These were the dividends that were declared by Steinhoff. And one of the things, as I say, what always amazed us was not only the willingness for vendors of businesses acquired to accept Steinhoff shares as a form of currency, but it was the willingness of shareholders to accept shares in exchange for a cash dividend. These were the cash dividends. So in those same 3 years I just highlighted, 2009 to 2011, you can see that there was virtually no cash dividend paid by Steinhoff. It was you as a shareholder were often incentivized with a 20% premium to take shares. As we know, those shares today are practically worthless. Moving on to the balance sheet, again, on the face of it, the progression of the NAV, the net asset value of Steinhoff, it looks like a nice, steady, growing business. This is a business you'd think was one that you'd want to own. The concern for us at Prudential was that if we unpacked what sat behind the NAV, it was almost entirely intangibles. As I say, this comes about from a business that is highly acquisitive. It's sitting in intangibles was goodwill, so that's the excess that you paid for the business relative to the carrying value of that business, but it also could be things like brands as well as customer relationships. These are these are highly subjective, and as part of that acquisition price allocation, what we could see is that there was this growing or ballooning intangible value on the balance sheet of Steinhoff. The difference between the column and the intangibles is essentially the tangible asset value, and in 5 of the years shown here, Steinhoff actually had negative tangible value. This we found particularly odd when you consider that it was a manufacturer of businesses, it owned factories, it owned physical plant and equipment, and yet all of that was offset by high levels of debt and these intangible assets. So these for us were the primary reasons why we didn't own this business, and as we can see today, it has proven to be a very successful decision on our part to not have exposure to Steinhoff. So the point I want to leave you here with is this: we didn't engage with Steinhoff. It was a business that we observed some concerning factors in the financials that meant that we actively took a decision to leave it out the portfolio. The next few examples are going to be those shares to which we did have exposure and that we needed to then take action in order to unlock appropriate value. The next case study, it's a rather obscure title. It's a 1955 movie about the construction of the great Egyptian pyramids. But I'm choosing to reference it here with regards to the BE top-up deal that Exaro implemented late last year. The pharaoh in this case is the former CEO, Mr. Sipho Nkosi, and the pyramid refers to the structure that sat behind the BE special purpose vehicle, which I'll unpack for you. I want to emphasize Prudential is not opposed to transformation or BE deals. We evaluate each of them on their merits. We just, in this case, we didn't like and we actually voted against it, not because we're opposed to them empowering, but there were a number of factors that we felt, and the one I'm going to unpack for you is this control structure, but also we felt the CEO, the current CEO, was himself deeply conflicted in that he was, on one hand, representing Exaro, telling us how they needed desperately to restore their BE credentials, and on the other hand, he represents the Chamber of Mines as their president, and he was in court fighting for the principle of once empowered, always empowered. As we know that court ruling later this year went in favor of Chamber of Mines and is being challenged, but essentially there was no need for this BE deal to take place. Exaro had already successfully done a BE transaction that had vested, and these same beneficiaries that were looking to re-empower the company had monetized their holding. That had meant that their ownership had gone from over 50% down to the mid-teens, and they were therefore arguing that we needed to get back above 30%. So why the use of the pyramid? Draw your attention to Exaro is the listed company. They were intending to create this new BE company which would own 30% of the shares. Ignore for the time being the confusion of the fact that Exaro themselves were going to sit as a beneficiary of the BE company. They were essentially going to warehouse these shares for future allocation to staff and empowerment parties. IDC was a significant participant, but the entity I want to draw your attention to is the BE Special Purpose Vehicle, which was essentially controlled 84% by Dream Vision Investments. Who sits behind Dream Vision Investments was what we took the most offense to or were opposed to in terms of the nature of the structure. Dream Vision Investments was 100% controlled by Sizwe Mining. Sizwe Mining, 50.5% controlled by Sizwe Holdings. And then behind Sizwe Holdings is Dynamite Investments, which is the former CEO, Mr. Sipho Nkosi, with a 52% shareholding. If you take these percentages and you do the maths and you cascade it down, Mr. Nkosi holds an effective interest in Exaro of 2.2%, but by virtue of the pyramid, he essentially controlled the entire 30% block. And that, for us, was not in the best interests of minorities. As you know, a special resolution would require 75% approval, but effectively you are giving someone with a 2% economic interest negative control of the entire company. For this reason, as well as some of the other reasons I cited, we took a decision to vote against the transaction. Unfortunately, we were unsuccessful, but I'll talk you through how the voting played out. 20% of the shares available to be voted were deemed to be related parties, related to the existing BE beneficiaries. And what was disappointing for us is of those remaining shares that could vote, 26% of them were not represented at the meeting. I'll unpack later. These had quite a material, or could have had a material outcome, change the outcome. The transaction, and there were multiple special resolutions, there were 5 or 6, and they were all interconditional on each other. I've just chosen to pull out Special Resolution 3 because it's the one that got voted through by the slimmest margin. It was 76% approval, 24% of shareholders, or of those that voted on this particular resolution, opposed the resolution, of which Prudential in the yellow color represented 35% of the no vote. So we were significant. We were just under 5% shareholder in Exxaro at the time. But what I take comfort from is that we weren't the only shareholders on the JSE that opposed this transaction. There were other shareholders that also took a dim view on the control structure. Had just shareholders in Exxaro of just 1.6% that had voted yes, had they voted no, this deal would have failed. As I say, all of the special resolutions were interconditional, so one failed, they all fail. And alternatively, had 2.1% of those shares that were not represented. The reason this percentage is higher is because those shares find their way both into the numerator and the denominator. So it's a slightly higher percentage, but this transaction would have failed. We exercised and we were vocal. We did engage with the company, and they did make some concession in that pyramid structure, such that Sipho Nkosi reduced his top holding, but he still has significant influence. And unfortunately, the deal did proceed. And as we've now subsequently discovered, the principle of once empowered, always empowered does bring into question whether there was a need to re-empower Exxaro. My third case study today is a small poultry producer, Sovereign Foods. It operates out of Uitenhage. Many people don't know where that is, but it's quite close to Port Elizabeth. The reason for the particular title, Rules of Engagement, and the image is that for the last 18 months of Sovereign's listing on the JSE, it was embarked in a protracted legal battle with a competitor, Country Bird Holdings, that attempted to take over Sovereign Foods. We were a significant shareholder in Sovereign, and at the time of its delisting, we owned almost 22% of the company. It is admittedly a very small company, and in our clients' lives was not that material. Our ownership in Sovereign predates this particular chart. We bought our initial stake from one of the controlling families in 2005, and hindsight's a wonderful thing, but I wish we had sold after this rapid period of share price appreciation. We originally bought at 5 Rand a share, and we saw it almost rally to 20 Rand. This was a particularly buoyant period for the poultry industry. Maize prices were low, and selling prices were high, and it encouraged a lot of investment into the sector. We saw a number of poultry producers, including Sovereign, embark on big expansion plans. Sovereign announced at that point in time that they were going to double their production from sort of 450,000 birds a week to almost 1 million birds a week. But what subsequently happened, and we've seen this in a lot of these agricultural related industries, a typical sort of boom bust, overcapacity gets added, maize crop goes through a bad cycle, and maize prices spike, and so the profitability dragged down the value of the share, and Sovereign was left funding a large portion of its expansion, not out of internally generated cash flow, but ended up with a significant amount of debt relative to its market cap at the time. Unfortunately for Prudential, we found ourselves having to bail out or to recapitalize the balance sheet, not once, but twice. In December 2009, it did an initial capital raise, and that was shortly followed in March of 2011 with a subsequent capital raise. We underwrote that second capital raise and resulted in our ownership increasing to the sort of 22% level. But as a condition or as part of that recapitalization, we strengthened the board, we put a new chairman in place, and the former CEO was asked to leave the company. Poultry industry in South Africa went through a particularly difficult time over the last sort of 7 years. We saw an influx of cheap imported product, and we've seen a maize price or rising maize price and a lack of pricing power that meant Sovereign, along with other poultry producers, were unable to pass through those price increases. This culminated in Country Bird making an unsolicited bid to take over Sovereign at 9 Rand a share. 9 Rand relative to This period offered, some investors a very short-term gain. We still felt that materially undervalued Sovereign, which I'll unpack for you shortly. But we engaged in supporting management in trying to thwart the Country Bird bid that culminated in a court case that prevented Country Bird from waiving one of the conditions, which was that it receive 50+1 acceptances for its offer. What was most significant about that is it simply bought us time. We could already observe that the cycle was turning and that the maize price was going to come down materially, and that would lead to a sort of improved profitability for the poultry sector. And the way the JSE rules work is if your bid is unsuccessful, there's a 1-year cooling off period before you can make a new counter bid. That 1 year provided the company and its advisors to go and solicit an alternative better bid. That came in the form of Capital Works, private equity company that eventually came and took us out at 12 Rand a share. I would have liked to have seen Sovereign remain listed. I still believe the 12 Rand fundamentally undervalues the company, but with Country Bird sitting as a 34.9% shareholder at the time, we were somewhat hamstrung. This is the fundamentals for the poultry industry. So that difficult period that I referred to, you had selling prices not maintain a sort of inflationary price increase, but you had very volatile maize price, and the selling prices were largely capped from these large influx of cheap imports. At the bottom, I'm showing the profit margin. In red is Sovereign, and then compare that to Astral, which is the largest listed poultry producer. You can see that it is a cyclical industry. Profit margins rise and fall, but at the point at which Country Bird came and tried to make this opportunistic 9 Rand bid, the industry was making losses. Maize price was at record highs and selling prices were depressed. But what one could see is that the maize farmers had an intention to plant, and in reaction to these very high maize prices, you were seeing a record sort of intentions to plant, good rainfall, and the SAFEX forward curve for the maize price gave us comfort that maize price was going to come down materially. Sovereign was subsequently delisted, but one can observe from this chart is that Astral, post the delisting of Sovereign, has seen a marked improvement in its own profitability, such that its most recent margins reported to the end of March are at record levels. So if one looks back at the share price, 12 Rand, I would argue, was a 33% premium to the share price that Country Bird offered us. So we did get a better outcome. But if we look at what Astral has done, since the delisting of Sovereign, Astral share price has almost doubled. So I do fear that we, again, were robbed. But as I say, with Country Bird sitting as an almost 35% shareholder, our concern and the reason for accepting the 12 Rand offer was that Country Bird could have very easily, at the expiry of their 12-month cooling off period, simply triggered an offer to minorities that we could have either accepted or rejected. It could have been 10 Rand, it could have been 11 Rand, I don't know. But thereafter, they would have been free to basically creep and accumulate control without ever having to make another offer to minorities. And hence the decision to accept the 12 Rand. In closing, my final case study is PPC. Some of you may have heard of the book Barbarians at the Gate. It refers to the 1988 takeout or attempted takeover of RJR Nabisco, an American food company. And in that book, that takes its title from a quote that the corporate advisor was saying to the CEO of RJR that they needed to push back the barbarians at the city gates. Why is it appropriate for PPC? PPC, we are today the second largest shareholder. We own just under 15% of the company. PPC was engaged in merger talks with AfriSam. These were initially friendly talks, but they couldn't reach agreement with the current owners of AfriSam on the relative value, and those talks then broke down, only for AfriSam to then find itself a white knight in the form of Canadian private equity company Fairfax, and the bid became hostile. During that hostile bid, we then had an emergence of other interested parties, Dangote Cement from Nigeria, CRH, Irish-based cement producer, and Lafarge, all expressing an interest in wanting to buy PPC. We opposed all of these. We felt it was the wrong point in the cycle, similar to Sovereign, and that PPC, there was better value in it remaining as an independently listed cement producer. As I say, one of the tough things here is that often the need for activism comes about because your initial investment hasn't played out as expected. PPC, we thought we initially had done quite well. Share price had halved at the point at which we made our initial purchase, but then we then walked straight into a rights issue. PPC had embarked on a very ambitious project, a series of projects, building 4 large-scale new cement plants across the African continent. It had meant that its balance sheet was quite stretched, and S&P chose to downgrade its corporate debt that triggered an embedded option in the bond documents of an early redemption. PPC didn't have the cash, and they came to the shareholders. We at the time were the 3rd largest shareholder, and ourselves, Lazard in New York, PIC, and Visio all offered irrevocable support to follow the rights issue. Through that rights issue process, we have become a larger shareholder, and it's through this difficult time where SA Cement has struggled with the entrance of both Sopaku and Mamba Cement, causing a supply imbalance in the SA market, which is PPC's predominant cash generative business. And it was in the process of still completing the plants across Africa, and so there was no contribution from the African plants. We were successful in the end. Throughout most of 2017, PPC traded under cautionary. In the end, through lots of engagement and writing of letters expressing to them our opposition to the proposed deals, the board eventually declined or terminated talks with all of the interested parties. We subsequently, together with another activist shareholder in South Africa, Value Capital Partners, earlier this year, took a decision to restructure the board. We have replaced the current chairman, and we've introduced new non-exec directors onto the PPC board. This is a valuation metric. It's a measure of a multiple of cash flow relative to the history. At the point at which AfriSam or Fairfax were making us a R5.75 offer for PPC, our biggest reason for objecting was simply it didn't reflect fair value, and the profits on which the multiple was being attached there was no contribution from Africa. We have, since the abandonment of those bids, we've seen a re-rating of PPC. It now trades back almost at the point at which we originally purchased. But I was quoted in the MoneyWeb at the time as sort of saying that you were offered, those of you that had followed a R4 rights issue were being offered an opportunity to bank a short-term gain, but that we'd yet to see the contribution from Africa, which is for us the main reason for remaining invested in PPC. So if one looks at over the next 3 years, where we see profitability going, it's expected to increase from about 1.2 billion rand of operating profit and to almost double, not quite double. Some of that comes from a sort of an improved profitability in the SA as their new plant in Slurry comes on stream, bringing significant cost savings. But it's these new African plants that are in the process of ramping up where we think you'll get some material uplift in future profits. We remain a significant shareholder in PPC, and we are confident that it was the right decision not to have accepted any of the bids during the course of last year. I'll end with this quote from Mahatma Gandhi. I think it's quite fitting in that in the case of Exxaro, we were ignored. In the case of Steinhoff, they laughed at us. And in both PPC and Sovereign, we had to fight. But at the end of the day, it's you, the client, that has won. I can demonstrate that by just showing the 7-year track record of the Prudential Equity Unit Trust relative to that peer group. We are very proud that this fund has consistently delivered top quartile performance and in fact ranks in the top decile of all of the funds available. That ends my talk. I will remind you, questions will come at the end.